Hello, everyone, and welcome to today's webinar. My name is Laura Ryan. I'm a partner in Thompson Hine's Employee Benefits and Executive Compensation Practice Group, and I'm joined today by my colleague in that practice group, Mark Kroboth. Today, we're going to discuss some important items that you should be keeping in mind as you are preparing the Form 5500 and preparing for the audit of the financial statements for your 401k plan this year. It's likely that not many of you have started this process quite yet at this time of year, which is exactly why we're coming at you with this information now, before you've kicked things off for the year, hoping to make sure that this process goes smoothly for you. We want to share some information about some important changes that you should be aware of related to the actual Form 5500 and some questions on that form. And we also want to share some tips that we think will help keep you out of hot water, so to speak, with the regulators, and hopefully keep you out of the crosshairs of plaintiffs' firms who are out there looking for the next 401k plan to target in connection with a class action lawsuit, which we seem to have no shortage of. So I think you'll find this information to be very helpful, especially this year as you kick things off. Before we begin, a few housekeeping items. Today's program is being recorded, and we'll send a link of the recording along with the presentation materials to everyone who registered for the program within about 48 hours of today's presentation. So you should have it before the end of the week. If you have any questions during the webinar, feel free to use the questions box located in the control panel on the upper right side of your screen. We'll try to answer questions as we go. I think we'll have a little bit of time at the end to address questions, and if there are questions that we don't get to, we will follow up, and you can certainly always email myself or Mark directly with any questions that you may think of after the program. We thank you for your interest, and we're going to go ahead and kick things off. I do want to just mention that the items that we're going to walk through today include the changes to the 2023 5500. We're going to focus exclusively on the changes impacting single employer 401k plan filings. Okay, so there are some other changes to the form and the instructions to the 5500 that impact defined benefit pension plans. Just a few items, nothing major. And there's also some brand new instructions around reporting that is required for what are called defined contribution groups, as well as MEPs, multiple employer plans, and PEPs, pooled employer plans. We're not going to be reviewing those today, but certainly if you participate in those arrangements or sponsor those arrangements, there are some other changes that you need to familiarize yourself with. But we're going to keep this focused on 401k plan 5500 filing requirements and changes to those requirements. And if you hear us talking about deadlines for filing 5500s, just know that we're going to just sort of assume you have a calendar year 401k plan, although not everybody does have a calendar year plan. And of course, if you don't have a calendar year plan, your filing deadlines and extended deadlines are different than they are for calendar year plans. We're going to talk a little bit about mention some tips for making sure you're properly reporting transfer of assets to or from your plan, or a merger of one plan into another plan, how to file that final 5500, make sure that's being filed in a way that it's going to be accepted as a final 5500. and properly reporting, the assets received on the receiving plan 5500. This is sometimes an issue that gets overlooked or not handled correctly in connection with acquisitions. When you acquire a plan. We're going to talk about reporting late considerations as you're thinking about and looking at whether any contributions to the plan were made, quote, late. What does that really mean? How those get reported on a 5500, and some considerations related to that topic. We're going to talk about how to review your 5500 to ensure that you're mitigating your litigation risk that might be triggered in connection with the way in which you respond to questions, or with the detail included in the footnotes to the audit report of the 5500. That's becoming kind of a more important and critical part of the 5500 filing process. And finally, talk a little bit about selecting an audit firm if you're thinking of making a change, or you need to make a change because your firm this year declined to continue its engagement, which we are seeing because we know that firms have a limited number of resources. Just some tips for going about that process of selecting an audit firm. And on that point, mentioning the audit, we're sort of, the bulk of this program assumes that your plan is large enough to require an audit. That's kind of the target audience for this program. But of course, not all plans, not all 401k plans do require an audit. Generally, if you have less than 100 participants, it's not required. Mark's going to touch a little more on that specific requirement. And then one final comment, again, as I said, we're focused on 401k 5500s, but of course there is potential, 5500 filing requirements that attach to health and welfare plans as well. There were no changes to those filing requirements, and that's sort of outside the scope of this program. But if you have 100 or more participants in your group health plan, then you've also got a 5500 filing requirement for those plans. So with that, I am going to turn it over to Mark to review the key changes to the form.
Thanks, Laura. So as Laura mentioned, I'm going to discuss the key changes to the Form 5500 applicable to the 401k plans, and there really are three. The first one that I wanted to touch on is the change in the participant counting method for determining whether you're eligible for simplified reporting. And that is important because if you have, generally speaking, under 100 participants in your plan, you're eligible to file the Form 5500 short form, and that form asks a lot fewer questions than if you're above that threshold number. And also, most importantly, you don't have to have an audit if you are eligible for that simplified reporting. So what was changed? So previously, if you had a 401k plan, you had to include all of the individuals who had an account balance in the plan, and then also everyone who was eligible to participate in that plan. So if you think of employees who are eligible to participate, but they have not elected to do so, and they don't have any money in an account in the plan, you would still have to count them towards that threshold of 100 participants to determine whether or not you would have to have the audit requirement. And starting in 2023, the rules have changed. And so now you don't have to include those individuals who are eligible but do not have an account balance in the plan. So if you're close to that 100 participant threshold, and for whatever reason, maybe you have a 401k plan that just doesn't have a lot of employees participating, or maybe you're close to the threshold, and you do have a good uptick of participation, and there's a few people that could sway you one way or the other. These are the type of plans that would be mostly impacted by this rule. And I think there's two key things to keep in mind here. The first one is that Secure 2.0 raised the amount of money that an individual could have for you to force them out of the plan to $7,000. It used to be $5,000. So there's, I think that's important to keep that amount in mind. If you're on the edge and you're close, the amount that you can force people out has been increased to $7,000. Most likely would require a plan amendment. The second thing is long-term part-time employees. This was something that came in under the Secure Act, and then it was tweaked by Secure 2.0. We've talked about this a lot. We've had webinars where we've talked about it, so I'm not going to go too deep into it, but essentially this allows employees who previously may not have been eligible to participate in the plan to now participate in the plan. And those employees would be counted towards this 100 employee threshold. If you're aware of the long-time part-time rules, there are certain rules for compliance and non-discrimination testing where those employees do not have to be counted. There is no relief here that they would have to be counted just as if they were any other employee. And then lastly, I just wanted to note that the 120 rule still continues to apply. And essentially what that rule says is if you were previously not subject to the audit requirement and then you went above 100 participants in your plan, but you stayed below 120, you could elect to continue to file the form 5500, the short form, and not have the audit requirement. So, and that rule remains in effect. So the second big change is regarding to our related to Schedule H, and there's a breakout of administrative expenses on that schedule. So everything that's bolded on the screen is something that's new. And essentially these fees they still comprised what you would need to report, but now it's just broken out into individual line items. So just going down them, salaries and allowances, those are salaries for benefits that are paid for employees who are plan employees. So a lot of plans will likely not have anything to report here, but if you have an employee whose sole job is to assist in the administration of the plan, that's where you would have to report those dollars. The second one is contract administrator fees. Obviously, this is not something new, but this is for an individual corporation managing clerical operations of the plan on a contractual basis. Once again, I know a lot of plan sponsors might have nothing to report in this field as well. Then record keeping fees are fees that are record keeping or accounting fees that are not contract administrator fees, and then also not independent qualified public account audit fees, because those fees, as you see on the screen in the next category, are required to be reported as their own separate line item. Investment and advisory fees are the same as they were before. In previous years, you would have to report those as well. And then we sort of get into a group of various fees: banker, trust company, trustee, custodial fees, actuarial fees. Legal fees are payments made to lawyers for rendering legal opinions, paid for litigation, and then other advice for the benefit of the plan. It should be noted that it's just for the benefit of the plan, it's not applicable to the benefit of plan participants. And then other trust fees are fees that are paid to or on behalf of plan trustees other than what is provided for in the above bank and trust section. So you kind of have to break out a lot more different fees and just be aware that you're going to have to go through and look and make sure that each one of these now makes sense rather than the single number. There was 3 or 4 different categories that were on former Forms 5500. And I think another important thing to remember is that these are public filings. So they're not only subject to scrutiny by the DOL when you make these filings, but any third party can go on and look and see, what Plan X is reporting for, fees that they've paid to their auditors, or record keeping fees, or investment advisor fees. So that's just another thing to keep in mind.
The other thing I'll note on this is the changes to the form were not finalized until sometime after the year began last year, for the 2023 year. And, if you have a record keeper that is assisting you in tracking the fees that are being paid from plan assets, it's possible that they didn't sort of have these new categories, these more, drilled down categories identified at the beginning of the year. So they may be looking to you to, fill in the blanks and sort of default to you in terms of, what helping them to account for these fees within these new, more precise and specific buckets. So be aware of that. I would also say, hopefully, if you have a third party preparing your 5500 for you and they're unable to provide this sort of breakout because they weren't sort of tracking it from the beginning of the year, they'll be notifying you of that, with some sort of cover memo or cover letter associated with the draft 5500 that they're delivering to you. So be aware of that, read that cover memo or that cover letter and understand what the Form 5500 may be missing this year, what information may be missing because it's new. And I think that's going to relate to the next change that you're going to highlight as well, Mark.
Okay, so the next change is on the Schedule R, and that's the form that's for retirement plan information. And there's 3 new questions that have been added on that schedule. So it's questions 21A, 21B, and then question 22. Question 21A is a yes or no question that asks whether the plan satisfies the minimum coverage and non-discrimination test, and whether it is aggregated with any other plans to do so. So like I said, that's just a yes or no question. A lot of larger plans that, if there's a larger control group, might have multiple plans that are needed to meet those testing rules. But once again, for many plan sponsors, it's going to be a no. If you just have a single plan in your control group. 21B asks, how does the plan satisfy non-discrimination requirements for employee deferrals and employer matching contributions? And interestingly, the choices, there's only 4 choices. You can notate that you meet the safe harbor, you use a prior year ADP, use a current year ADP, or not applicable. And it's important to note that the question does say that you can select more than one of these options. You might have certain groups of employees who have meet the safe harbor, and certain employees who maybe don't, or you have, you use prior year ADP test for non-highly compensated, or a prior year ADP test, but you have a current year ACP test. So the choices are interesting, but you can pick multiple choices. And then the last line, this is just for entities who are on a pre-approved plan, and the form asks for the date of the opinion letter and the opinion letter serial number. So if you have a plan that is not individually designed, when you look at your plan document, there's a bunch of options that you can go through and select with a check mark, and you don't have that information, you can reach out to your plan document provider. They should obviously have that information at the ready. So now we're going to move to some of compliance issues to be aware of while you or your vendor is completing your Form 5500 requirement. And the first one is to make sure that you are accurately reporting the transfer of assets to or from a plan. So this really involves plans that merge into another plan, or if you have a plan that is merged into your plan, you're going to want to make sure that you're accurately reporting the information. So there's questions on both the Schedule H and the Schedule R, the two forms that I spoke about earlier, that ask whether or not there has been a transfer to or from your plan throughout the year. If you're completing or reviewing a Form 5500 for a plan where the assets have been transferred, Schedule H asks for the plan name, the EIN, and the number, or the plan number, I'm sorry, of the plan that's receiving the funds. And they also ask, or the form also asks, the amount of the assets that were transferred to or from a plan. So if you have, if you have a plan where there was a plan that was merged into your plan during the year, and you're reporting a number on that form, you're going to want to make sure that that other plan, which would presumably be their final Form 5500, also reports that same amount. And then I think it's important to note that for mergers that are occurring at or year end, it's important to determine whether all of the assets were transferred by December 31st. If they're not, then you will need to file another Form 5500 in the following year, and that's possibly going to be subject to an audit, depending on the number of participants that are in the plan. So that's something to keep in mind. Okay, so reporting late contributions. This is something that I think we see happen a lot, and more often than you would probably think. So what is a late contribution, and how does this happen? So payroll is run, let's say you have a participant that has a flat dollar or $100 election. So payroll is run, let's say it's on the 15th, and the company takes that $100 and they're supposed to, send it to the plan, put it into the plan, and it just doesn't happen timely. So payroll's run, you get your money, but the company is now just holding this $100 that isn't theirs, that's yours, that should have gone into the plan. And so the DOL plan asset rule requires that the employer segregate the money as soon as administratively possible, but in no event later than 15 business days following the end of the month at which the amounts are withheld. And there's a common misconception that this is a safe harbor rule, but it's not a safe harbor rule. There is a safe harbor rule for smaller employers for 7 business days, but typically for larger employers that are continuously taking the money and funding the plan almost instantaneously, we've seen 1 day, 2 days, 3 days is too much in the eyes of the DOL for how long it takes to segregate assets. And where this becomes a problem is there is a question on the Form 5500 that asks whether or not you've had late contributions to your plan. And so when you have an audit report and the auditor is going through and they're checking to see, okay, did this plan where the contributions timely made, they're going to recommend that button is checked, or that check mark is checked. And what that's going to do is that's going to be a flag in the DOL system. Hey, Plan X 401k plan, they're saying they had late contributions and they weren't corrected. So then the DOL, we've seen letters triggered that then they send something to the plan sponsor that says, hey, you reported on your 5500 that you had late contributions for the plan for this plan year. Have you corrected it? If not, we have this program, the DOL's Voluntary Fiduciary Correction Program, that you should strongly consider. It is an optional program, but it's a way for you to come forward to the DL and say, hey, we had these late contributions. This is what we did to correct our error. Essentially, what do you think? Do you agree with our correction process? And it is a pretty cumbersome process. I mean, they're going to ask for a lot of documentation. They're going to ask for check registers or payroll statements that show that the plan sponsor withheld the money when they said they did. They're going to want to see trust reports that show the money went into the plan when they say they corrected it. And then they're going to want to see calculations for the lost earnings. So if you have money that could have gone in on the 15th and you didn't send it until the 20th, there's 5 days that interest is potentially accruing on those dollars, and the DOL is going to want you to fund those dollars as well. There's also a place for them to, or for you on the application to note that you filed a form 5330, which is for an excise tax on those amounts. So essentially, when you pay these monies late to the plan, now the employer or the plan has taken an impermissible loan. So they're using your money that they didn't have a right to use, whether or not they've used it in any manner. It's treated as a plan loan, and there's an excise tax that goes along with that. So all that being said, if you can make a reasonable argument why you don't think that your contributions were late, and it's really a fact-dependent situation that you're going to want to not check the box to say that you had late contributions to the plan.
Yeah, let me, we actually have a question that touches on something that I just wanted to bring in here. So the question is, if you have a change in record keeper and a few pay periods are not remitted as timely as under the old record keeper as we try to work the bugs out of the process, is that considered a late contribution? And before I answer that, I'll say, we see this in change in record keepers. We also can see this in change in payroll systems or, payroll systems that are tied in with HRIS systems. And, we know that those types of changes do occur within organizations, and they can be disruptive to this process. It really is going to go back to what Mark said is a facts and circumstances analysis. And the favorable facts are going to include things like, did you have a documented and well thought out process for addressing this? Even just normally, just without any kind of changes, do you have a good and well documented process? Were you following that process, but the facts and circumstances were such that there was a delay that was sort of beyond your control. It was sort of not foreseeable. An example that I give is, you have a process, and you even have you have a normal process, and you have a backup plan for that process if the people or person that's responsible for this on a normal basis is, let's say, out on vacation, et cetera. But you have sort of a parade of horribles. That person is out on vacation, and then their backup person is out on some sort of emergency. They were out on an emergency type of leave that was not foreseeable, and so that resulted in a one-day delay, to the normal process. I can get pretty comfortable pretty quick that based on those facts and circumstances, it was as soon as administratively feasible. Same thing with this record keeper change and payroll change, right? If you're making those kinds of changes, they're going to happen. They're not, sudden things. They're not done with a lot of forethought. And I think as long as you can demonstrate that you have a plan and a process in place to ensure, that these contributions are able to be segregated and sent to the trust as soon as administratively practicable in light of the situation and what's happening, i.e. a change to payroll provider, a change to record keeper, you can pretty quickly, I think, point to facts and circumstances that, you know, might support determining these weren't late, even though they were forwarded, you know, several days later than our normal process would have resulted in. You know, the auditors are going to kind of start from the position of this, what's your normal process? You know, you normally get them in the day after the payroll runs, or by no later than the second day after the pay date. And if anything falls outside of that, sort of their first sort of assumption is going to be, okay, this was late, you know, because it was later than the normal process. But I think that that's rebuttable. And, you know, really the DOL doesn't, there's nowhere in the DOL rules that say that says that, you know, that it's based on your, whatever your normal process is. The other thing I'll say, because I do hear this sometimes, and I think this should be pushed back on if you hear a similar comment. Sometimes when there's a change in the record keeper or some other event that's like resulting in some sort of blackout, you know, maybe it's a planned merger, you know, and there's going to be this sort of blackout period associated with your plan where the record keeper doesn't want to process any types of transactions because they're trying to, you know, perform a reconciliation in connection with, let's say, a planned merger, which is perfectly, you know, reasonable. But sometimes I hear, you know, the record keepers say, so therefore, even though you're going to have a couple payrolls, just hold those contributions and don't send them to us. Now, I think, you know, you need to scrutinize that direction, because the requirement is for those dollars to leave the employer's general assets and get into the trust, the 401k plan trust account. That's the requirement. As long as it's in the trust, it's in the plan, it's, you know, accruing whatever, you know, interest, it's not in the employer's coffers. That's what this DOL rule is focused on. It does not have to be allocated to plan participant accounts immediately. I mean, obviously, you still want to allocate it as soon as administratively practicable, but the key is to get it sitting in the trust ASAP, even if the record keeper is not going to be able to process an allocation of that contribution until after it's done whatever kind of, you know, reconciliation work it's working on. So there's the bottom line is, you know, really question this. Ideally, you know, this is something that you've even identified before the auditors get in there. You've pulled payroll reports, you've looked at every single payroll run and every single deposit into the 401k plan. You've already identified, you know, we see, you know, ones that are late, and you've already done this analysis. That's the ideal, because then we can sort of address this head on even before the auditors are at your doorstep. But if the auditors are bringing this up kind of at the end of the process, you know, just be cautious and sort of just accepting their characterization of these things as late contributions, because it can trigger these things that Mark was talking about: reporting, letters from DOL, you know, voluntary fiduciary correction program filings that result in, you know, multiple exchanges with the Department of Labor about, you know, what happened here, when at the end of the day, it was like, you know, $20 in lost earnings, and you're pulling your hair out trying to understand why this is taking so much of your time. All right. Okay. So let's shift to this concept of mitigating litigation risk. And, you know, I said litigation risk, but frankly, it's also mitigating audit risk. And by audit, I mean, now I'm going to use the term differently, an audit by the Department of Labor or Internal Revenue Service of your plan. It's always been kind of known that 5500 information, it can be and is used by the IRS and the Department of Labor to trigger plans for an audit. Now, it's not the only trigger. I want to be clear on that. There's other ways in which your plan can be sort of become a target of a regulator audit, those would include things like participant complaints, people calling the Department of Labor and saying my employer is, not depositing my 401k contributions, timely. And random. I mean, both organizations have said that, they do randomly select plans for audit. But they definitely use Department of Labor information. We've been told in connection with audits. Sometimes they don't like to reveal what triggered the audit, but sometimes some agents will. And they'll say, it was the answer to this question on the 5500. I will say that sometimes what's even, I was going to say, whenever one of our clients receives notice of an audit from either DOL or IRS, it's one of the very first things that we do is to pull the last 3 years of 5500 filings for that client to see if we can spot something on that return that might have triggered the audit. And what gets even worse is if you suddenly realize that you see maybe what's triggered it, and I'll talk about this in a little bit more detail, but let's say that a number on the Schedule H was placed in the wrong line item. Like instead of saying there's X number of dollars of outstanding participant loans, you put it in the block above loans, which is, I have this flagged here, which is real estate. So real estate is right above loans, and if your plan holds real estate, that's sort of a high risk holding, and it's not going to surprise me if the DOL flags that return for an audit. And I've actually had that happen where when I look at this, it's like, wait a minute, you reported X dollars in real estate being held by the plan. I said, oh, well, that was supposed to be on the loan line item. And to be clear, if that happens, you will not be able to simply say we put that in the wrong line and please go away. No need to look further or to conduct your audit. They will conduct their audit, and you're not even likely to know that that's what triggered it anyway. So this is one of the points here is mistakes can be made. Mistakes can be made by the third parties that are preparing your returns. They can be made by the auditors. They can be made by you. And so, multiple eyes, close review and scrutiny by all parties, even legal counsel, is highly recommended here because the stakes are high. And, I just talked about DOL and IRS audit, but these days we also definitely can see that plaintiffs firms that are, again, trying to find their next target for 401k fee and investment fund litigation. And if you don't realize how prevalent that is, you're probably living under a rock. That plaintiffs firms are using data and information reported on a 5500 to target plans. And I'm going to give a concrete example of that in a slide or two here. But keep in mind, how can they do that, you may ask? Well, if you didn't know it, the 5500s that you're filing are publicly available. They are very easily findable on the Department of Labor's website through a few clicks of a button. You can get right to what's called a 5500 search tab on the dol.gov website and type in the name of the plan, the name of the company sponsoring the plan, if you have it, the EIN of the plan, any of those pieces of data. You just need one, and it will immediately pull up all the Form 5500s either for that plan or that are being filed by that employer. And you can read them. It's all right there with the audit reports attached. So these are public documents. They're also publicly available to your plan participants. And so a participant can pull them up and review and read what's on there. So the bottom line is, again, this final bullet on this slide is, even if you have a third party that you have hired to prepare your 5,500, let's say that's your record keeper for your 401k plan, which, in fairness, they are the ones that probably, possess the bulk of the information that is needed to file the 5,500. And that's fine, and that's a very common practice. But don't simply rely on that draft and sign it and file it without you yourself reviewing it. Not that you'll be able to validate with 100% accuracy all of the information identified, but you can certainly review it for red flags, for things that don't make sense. For some answer that's answered in a way that you're wondering, why was it answered that way? I don't remember that we had a blackout of in our plan, or I don't remember that we didn't distribute benefits when required. There's actually a question on there. I don't remember the exact wording on the Schedule H. Yeah, I don't have it. I'm not finding it, but and question it. Is this right? Especially this year with the changes to the 5,500. Again, I think that there's going to be some omissions of information simply because the information was not really being collected for purposes of the 5,500 filing. And this goes for the audit report footnotes as well. Again, I think some people have this impression the audit firm is preparing that they're their words, and we can't really scrutinize or question or ask for revisions to be made to the footnotes of the audit reports. That just isn't true. I mean, obviously there are certain things that are required to be disclosed, and maybe even disclosed in a certain way, and we're not going to pretend to be CPAs and accountants. I don't pretend to be one, but I can certainly, review and engage in identify inaccurate, recitations of the plan, its eligibility criteria, the level of contributions, the vesting schedule, all of those details. Sometimes those are on a set it and forget it kind of mode that, unless you review it and point out changes, sometimes the auditors, are not the best at keeping those footnotes, updated and revised. They only come in once a year. They're not as familiar with your plan as you are. So really critical to make sure that you're doing a thorough review of the entire 5,500, all schedules, and the audit report. A couple things to pay special attention to would include the Schedule C. This is key. Schedule C is where the breakdown of the fees that were paid by the plan are being reported. And the way they're reported is you say the name of the entity that received those fees. You report how much in fees they received. There's also codes that are entered to describe what was the service that this person provided in exchange for these fees. No question, this is data that the plaintiffs' firms are focused on. They love to look at this schedule. They love to see, how much in fees were paid to the one that received the biggest amount of fees, which tends to be the record keeper. They go where the money is. What they do quickly is they take that number and divide into it the number of participants with an account balance at the end of the year that's reported on page 2 of the 5,500, and they come up with kind of a approximate estimate of what the per head fee for the administrative services was. And then they take that number and they compare it to benchmark data that they use for purposes of their litigation, and quickly allege that it was, outside the range of reasonable fees for similarly sized plans. Do that math yourself. Again, it's never going to come up to be necessarily exactly the per head fee that your plan is paying, because these fees tend to be charged over a monthly or a quarterly period of time, during which there's a different number of participants in the plan than there is at the very end, kind of on a snapshot basis. But do the math and make sure it sort of looks about right. Like, that the plan is paying $45 a participant. I'm just going to, pick a number per year. And when you do that math, it shows $85. Then question that, wait a minute, is this a mistake? Why is this looking like it's about $85 when I know our participants are being charged $45, a year? Very carefully review the expense information reported on a Schedule H, especially because, as Mark just reviewed, there's been changes to those categories. Make sure things are being properly categorized, and make sure it kind of ties back to what's being reported on the Schedule C. Again, it may not tie back exactly to the penny, because the way in which these fees are reported on the Schedule C and the Schedule H can be different. The Schedule H can be on an accrual method basis versus a cash method basis, whereas the Schedule C is typically cash method. So I'm not saying they're going to, match exactly, but they should come close. If you're reporting an auditor as having received a fee on the Schedule C and there's no audit fee reported on a Schedule H, that's a question. Why is that? And it may be because it wasn't properly identified as an audit fee by the record keeper, so it didn't show up in that line item, and that will necessitate a revision. Make sure the footnotes accurately summarize the terms of the plan. We talked about that. Pay special attention to statements made in footnotes regarding forfeitures and use of forfeitures. Even ask whether those statements are necessary. I mean, on the next page, I'm going to explain why I'm saying this, but I've seen footnotes now, because I've been focused on this, that are saying like the plan had $10.21 in forfeitures, and it used that amount to offset expenses. Is that material? I mean, for a large plan, why is this even in there? And again, it's kind of an autopilot thing, but I think it's fair to question the auditors. Do we even need to mention the word forfeitures in our footnotes? Again, I'll explain why I'm saying that in a minute. And then pay special attention to any statements made in the footnotes regarding the payment of plan expenses, how much the plan pays, how much the employer pays. Because again, that's a sort of a target of these lawsuits. So we've seen very recently a new theory being touted by the plaintiffs' firms, and they're targeting plans that have basically a very large amount of forfeitures. I'm talking in the millions of dollars of forfeitures. These tend to be multi-billion-dollar plans, and they're reporting fees having been paid by the plan on a Schedule C of maybe $1 million or a little more than $1 million, but yet in the footnotes you can see pretty quickly that they had $7 million in forfeitures that are being reported as having been used to offset employer contributions, which is a very common practice, which is probably very consistent with the plan document, which has been blessed and approved by the Internal Revenue Service. So at this point, we're not really sure where these lawsuits are going to end up and that they're going to be successful. But, it's still sort of just from those little, bullets, easy to see where they came up with their theory and how they targeted these plans, who now are stuck having to defend these lawsuits and these allegations. Even if ultimately the employer is successful in defending, they still will have spent a lot of time and money defending these lawsuits. So it's really, this is kind of a very, very new focus here. These lawsuits were just popped up, was it just last year, right? Late last year, we started seeing, yeah. in the last 6 months, I'd say. All right. Just a few tips for trying to make the audit process go smooth. Start the process early, ensure that the report is finalized to the extent you can, really sort of pressure the audit firm to finalize it more than a few days before the filing deadline. We have seen situations where it remains under sort of quality review or partner review up until a few days before October 15th. And then, a list of 10 follow-up items and questions are sent, and there needs to be a mad dash because we've got a filing deadline. So to the extent possible, try to avoid that last minute. That's another thing where, late contributions, you suddenly realize that they're going to report late contributions 2 days before the filing is due, and there's not a whole lot of time to really perform this assessment of, oh, wait a minute, based on the facts and circumstances, maybe these weren't late contributions. Ensure that any pre-work that you're required to do, prior to the auditor showing up is completed, and that responses to auditor document requests and questionnaires are provided timely. Again, review the draft audit report, including all footnotes, closely. Don't hesitate to ask questions. Even if they're not finished with their report, ask for a draft. Let's see a draft of the report right now and review it now so that you can begin to flag, revisions and questions that you have on that audit report. And don't forget that if you do change audit firms, you're required to disclose that change on a Schedule C. I do see people sometimes forgetting about that. Selection of an audit firm is a fiduciary function, especially if the fee for the audit firm is going to be paid from plan assets. And the DOL has kind of been, publicly critical of certain audit firms and audit reports that they claim, the firms aren't qualified and the reports are deficient. So they've been focused on the audit aspect and the audit reports. The Department of Labor has published a list of firms that they think are, qualified firms based on the number of employee benefit plan audits that they perform a year. So if you're searching for a new auditor, you do want to make sure that, they're on that list, and a question needs to be, how many employee benefit plan audits do you perform a year? If it's, 1 or 2, then they're probably not the best firm to select for your EB plan audit. Doesn't mean they're not a great audit firm, but they just, EB plans are a unique, subset and unique animal. And then again, as I mentioned, if you're charging audit fees to the plan, you want to make sure that you have established a basis for determining the reasonableness of the fees. So if you're, in the process of selecting a new auditor, you're going to want to probably solicit, fee estimates from more than just one audit firm. Solicit from a couple. These fees don't tend to be too high, no matter what, but it is a requirement. It's part of satisfying your fiduciary obligation under ERISA. Let's see, I was looking, we did get a couple of questions. Yeah, let's see here. Okay, I think one of the questions related to the forfeiture lawsuits that I eventually got around to mentioning. There's a question about, is there a source for how the auditor decides what to include in or exclude from the footnotes? It's a good question, and I think there is. Obviously, there is. There are, standards that accounting firms are required to follow. I mean, I'm not a CPA in an accounting firm, so I'm not intimately familiar with those. I do know generally that, materiality is one of the, important driving factors as to whether or not something, needs to be disclosed in the audit in the report. And even that, I think, is viewed differently in terms of, you know, what does an auditor view as material or not. But again, I have engaged in conversations with auditors, and I do know that there is wiggle room. And in fact, the audit firms don't want to be including language or statements in reports that are increasing risk to the plan. So in that regard, you know, you're really all on the same page in ensuring that we have, you know, accurate statements, that we're not making statements that we're not required to make, that, you know, might sort of, you know, raise a red flag somewhere. So again, I think the best way to address this is to engage in a conversation and a discussion with your auditors just along these lines, and try to come to agreement on, you know, like I said, an accurate set of footnotes, but also a set of footnotes that doesn't contain a lot of extraneous, unnecessary, immaterial, you know, information and disclosures and statements. All right, well, I'm not seeing any other questions in the queue. I did just want to mention that we have a 4-part webinar series that our group is getting ready to kick off. The first one is on March 27th, not having to do with 5500s, and in fact, not having to do with 401k plans, but having to do with health and welfare plans, and the need to really focus on establishing and following a very prudent fiduciary process and structure as it relates to, you know, the administration and oversight of the company's health and welfare plans. Again, unfortunately, this is really being driven by a pretty, you know, significant uptick that we're seeing in litigation targeting group health plans and alleging various breaches of fiduciary duty in selecting, you know, the vendors for the group health plan that are then going to be, you know, charging fees and incurring costs for the plan. So I think we're going to be sharing some very good and cutting edge information in that webinar series. If you're not already on our mailing list, you can email Mark or myself, and we can get you added to that mailing list. If you're on our mailing list, you should have already seen an invitation for these webinars. Again, the first one coming up here on March 27th. As I said before, we will be sending out a recording of this program as well as the slide materials within 48 hours for anyone who registered for this program. And we hope you found this information helpful. If you have any questions following the program, feel free to reach out to myself, to Mark, or to, you know, the Thompson Hine lawyer that you typically work with on benefit matters. And with that, we're concluded. Thank you.